Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Morning, everybody. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly and economic market commentary for the week beginning today, Monday, June 10th, 2024. You can also follow me intra-week on both X and LinkedIn if there are any important economic or market developments. The presentation you are about to see and or hear has been developed by us, Cantor Fitzgerald Investment Advisors, LP. It is designed for use with financial advisors as well as their clients, but each are expected to make their own investment decisions. Nothing in the presentation is investment advice. You are advised to consult your own tax advisor. There's no tax advice. The opinions expressed herein are exclusively mine and may differ from those of Cantor Fitzgerald Investment Advisors, its parents, its affiliates, or other portfolio managers in the firm. We had a great week for equities, sounding a little bit like a broken record. Large cap, mega cap technology companies dominated the investment performance. You can see up 1.36% in the S&P 500, while mid and small cap stocks down significantly, down about 2 and 2.5%. International markets were positive, led by emerging markets. Interestingly, though, the biggest of the emerging market, China, was flat or down 1 basis point on the week. Fixed income rates went lower as expectations of a Fed rate cut rose, as expectations of lower CPI and PPI numbers that are due this week began to come down based on some of the data we got last week. So bonds rallied a little bit. The aggregate bond index, up 44 basis points. Long-dated U.S. Treasuries, which are more sensitive to interest rate moves and interest rate expectation changes, up about 139 basis points. Moving along, we've got the manufacturing PMIs, the finals for the month of May, as well as the services PMIs. Let's start with manufacturing. Remember, that's about 15% or so of the U.S. economy. May S&P Global, that's the name of the company, their U.S. manufacturing PMI, rose from 50 to 51.3. That's expansion. The markets looked at that and said, okay, the economy is strengthening. Perhaps manufacturing perhaps is strengthening. But then we got the twin reading from ISM, the Institute for Supply Management, told a little bit of a different story. They said manufacturing in the country in the month of May declined to 48.7. Now, 50, above 50 means it expanded. Below 50 means it contracted. 18 of the last 19 readings have been below 50, and the one that wasn't was at 50.3, right there, just a couple of months ago. New orders were in contraction, production still in expansion, but barely so, and employment actually went into expansion. So that's the manufacturing. Then we picked up the services readings, starting with S&P Global, rose from 51.3 to 54.8. That was big. Now, services are about 85% of the U.S. economy. So quite an important reading there. The reading from ISM, Institute for Supply Management, corroborated the one from S&P Global. They said we rose from contraction in April to 53.8 in the month of May, significant expansion. Business activity, anything above a 60 handle is, you could say, robust or ebullient. That's the largest gain there since March of 21, the highest absolute reading since November of 22. New orders up and employment up, but still in contraction. The reading was higher, but that was still in contraction there. Moving along to construction spending, April construction spending down 0.1%. Estimate was for a 0.2% increase. What this is showing is that the higher rates, the longer that rates stay high, I think when the Fed finally got to this level of 5.25, 5.5, a lot of market participants said, okay, that's it. The next move is a cut. And what we've got instead is higher for longer. We're staying high, waiting for those inflation numbers to come in and to come down. And so that's finally beginning to have an impact on construction spending, construction employment, obviously residential real estate transactions, the financings that go along with that. All of that is really starting to take a hit. And that's disinflationary, but taking a hit from the higher rates for a longer period of time. And then we got auto sales for the month of May last month. They rose from a 15.7 annualized rate to 15.9. The estimate was 15.8. If you look here at the line where my red dot is going, that's the highest reading in 3 years for auto sales. So while we have data, some data suggests the economy is slowing, there's yet other data that shows expansion, right? That services number, things like auto sales kicking up pretty substantially too, right? So then we've got factory orders for April up 0.7%. That's 1, 2, 3 straight months of gains there. You can take a look now. The other thing we got last week was a whole bunch of data on the labor market. Now, at first glance, if you looked at the chart of job openings or JOLTS, if you looked at the chart from, let's just say, here on, just like a 3-year chart, you'd see job openings going down, 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 down. You might interpret that as being negative for economic growth. What it's really negative for is inflation. This represents, hopefully, a trend of disinflation. Notice I didn't say deflation in the economy, a disinflationary trend as we go from more than 12 million job openings 2 years ago to now 8.05 or 8.06, still above the pre-COVID level, but barely. And I think the jobs market will be in better equilibrium when we get back down here. So I still say it's providing some inflationary pressure to the economy, the number of job openings, but not nearly to the degree that it has been in the last couple of years. An interesting graph that my colleague Eric Johnston from Cantor Fitzgerald came out with in his commentary this morning that I liked and borrowed is this here. It shows the year-over-year percentage change in jobs openings. So taking data from the prior graph, and you can see back here it was 100%. It was a doubling of job openings year over year. We're now down to a decline in the number of job openings of 20%. You can see how correlated that is with the orange line, which is the year-over-year total return of the S&P 500. So what his theory is that the blue line sort of drags, if job openings are going up, that means the economy is expanding. Therefore, it's likely that the S&P does well when the economy is expanding. On the other hand, with job openings going down and this gap now between the two, is the S&P likely to roll over or moderate its year-over-year gains? The answer is probably yes. We've had a big run, so therefore the year-over-year gain, even if it's flat, won't be much going forward. Just an interesting graph to take a look at. Staying on the theme of jobs and jobless claims, weekly initial claims for unemployment, 229,000. We're starting to perk up a little bit, but it's de minimis. We did that last summer too. You can see the pickup in 2023. We got to 240, 250 before getting all the way back to 200. So nothing to see here, as we like to say. We then got the twin jobs reports. That's ADP employment. That's from Automatic Data Processing, the payroll company that many of us use. And then we got the one from the Bureau of Labor Statistics from the government. So ADP came out on Wednesday. They say that the economy added 152,000 jobs. That was less than expectations, which the market sort of interpreted as good. More disinflationary signs, more signs to suggest the Fed could cut rates sooner rather than later. We also had April revised down from 192 to 188. So that was kind of seen as a nice, mild, moderately disinflationary report, followed up by the Bureau of Labor Statistics report, which they say the economy added 272, which was way above the estimate of 180,000. So sort of conflicting reports there. Who has the better statistical model? Well, ADP's is very good because they actually do payroll for companies, but they tend to focus on the bigger companies. And the government report, the Bureau of Labor Statistics, has an important component in it called the birth-death model. and it estimates based on filings for new businesses. And a lot of times those use different payroll companies, smaller, the ones that focus on the smaller companies, the birth of businesses, that is. The unemployment rate in the BLS report, Bureau of Labor Statistics report, has been steadily kicking higher, but it's still historically very low. It's at 4%, which is, pre-pandemic, right? We were 3.8, 3.9, 4%. We got really, really, really low. We're getting back to that 4%. Even though we're adding jobs, the labor market's expanding. So that's how that can go up a little bit. It was above expectations of 3.9. We also saw a nice, healthy jump in hourly earnings on a year-over-year basis, 4.1%. Higher earnings means higher spending, means higher standard of living. This is the great promise of capitalism, but it also can translate into component pricing input pressures into corporations, which can translate into that CPI number. So there's a balancing act there. Next, we got the balance of trade report, or the trade deficit report, as we like to call it. And it surprisingly really expanded last month. And historically, when we saw those big expansions, it was a lot of times it was petroleum based. That's not really so much the case for the United States anymore. But trade deficit is a subtraction from GDP. So when that expands, GDP goes down, and you have to really look through it to see, well, is that bad news or good news? Well, if imports were up 2.4% and exports were up 0.8%, all it really says is that the U.S. consumer was quite strong, was able to spend and import lots of goods, and those goods were maybe priced competitively for U.S. consumers. So it's mixed news, but it's definitely not bad news, I guess is the best way to put that. The other thing we saw last week was that consumer credit was up modestly, 6.4 billion on the month, and the estimate was 10. And the revolving credit, that's your credit card debt, folks. You can see that actually ticked lower. See that on the far right? That hasn't happened in a very long time. It happens during recessions, obviously, when people lose their jobs. Why is that happening? Well, two reasons. Number one, consumers are adapting to higher rates, going, maybe I don't really want to carry this credit card balance at this high number, or I don't want to charge something if I'm going to have a high finance charge. The other thing that's happening is delinquencies are high across all time, whether it's 30, 60, 90 day, whatever it is. I think I showed you 90 days on auto loans and credit cards last week. But about 3.2% of all consumer debt outstanding right now is in some state of delinquency. And that just shows the bifurcation between the sort of the ends of the economy. The inflationary pressures, for investors like you and like me, well, our homes go up in value. Our stocks, if they're able to pass things on, those go up in value. And therefore, higher prices of meat and eggs and dairy and gasoline and heating are not as impactful to us. Our wages may also go higher, right, with the annual adjustments. But for the folks that are at the lower end of the economic spectrum, the lower end of the earnings spectrum, who do not have the assets that we have as investors, those people are disproportionately harmed by the impacts of inflation. And that's why we're seeing those delinquencies really start to kick up. Okay, the other big news last week, and the reason bonds caught that bid and went a little higher, and expectations for the Fed to cut rates sooner went a little bit higher, was that two important central banks in the world, none of them are as important as the FOMC for obvious reasons, given the size of our economy and our influence in the world, but the European Central Bank and the Bank of Canada both cut their short-term rate. Now, this is unique and unusual because normally they don't do anything until the Fed does it. If the Fed cuts, then they cut. If the Fed hikes, then they hike. But they broke that connection. The Bank of Canada cut by 25 basis points, first cut since March of 2020. The ECB cut 25 basis points, first cut since March of 2016. And then the Fed meets this week. We have a 2-day meeting this week, Tuesday and Wednesday. Wednesday will be the announcement on our Fed funds target rate, which was 5.25. The last cut was March of 2020. And the futures markets and yours truly are saying there's no way the Fed is going to follow the ECB and the Bank of Canada because our inflation numbers are still too high. And employment is still full. There's no reason to cut at this point. The market doesn't think they will either. So put two graphs on here just for your edification. What is the Fed doing to control inflation? They're doing what it can. Its two main tools are its balance sheet. So when the balance sheet's going up, they're printing money. When the balance sheet's going down, they are shredding money. They are de-printing money. And they've gone from 8.9 trillion to 7.3 trillion on the balance sheet since March of 22. So that is a $1.6 trillion shredding. That's very significant to try to bring down inflation. But the balance sheet is still far higher than it was before the COVID pandemic. So really, they have a long way to go on the balance sheet. The other thing the Fed has been doing is increasing the Fed funds target rate, where it is now sitting at 5.5%, and it has been since March of 2022. The expectations now are that the Fed may have its first cut November 7th, which would be after the general election. In terms of economic data, nothing big today. Small business optimism on Tuesday. CPI and PPI both come out this week, along with the Fed's decision on Wednesday. As I mentioned, jobless claims, import and export prices, and consumer sentiment. Couple of big earnings reports this week, Oracle, Broadcom, and Adobe. Thanks for tuning in, everybody. As a reminder, we're on YouTube. The name of the channel is Slaying Bulls and Bears. Our tagline is we want to make the complex and complicated simple and sensible. You can also do audio only on any podcast.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.